Hello. Today we're going to be talking about the Bank of Italy. I'm Greg Reyes,
And I'm Patrick Terry.
and I'm just going to start with a brief overview. So we'll start with the history of the Bank of Italy. So during World War I, during World War II, and after that. The structure of the bank, we're going to talk about the different sectors they have, how many sectors they have, what these sectors do. We're going to also talk about the uniqueness of the bank, so what separates the Italian bank from all the other banks around the world. And we're also going to mention the actions the bank took after the 2008 financial crisis. So, what policies they adapted, what they liked about these policies, what they didn't like, and how it affected their economy. And then lastly, we're going to talk about the Bank of Italy compared to the Federal Reserve. So, pre World War I in 1861, Italy was in a rough state economically. The banks were able to issue their own banknotes. So, this kind of had a competition between the banks. And at the time, lira was easily transferable to gold, meaning that Italy used the gold reserve. So they had their lira backed up with how much gold they have. So in order to fix this issue, there became a law called the banking law. And this actually created the Bank of Italy in 1893, which also made it that 40% of these notes had to be backed by gold, meaning that they couldn't issue any more. So 40% of these notes had to be guaranteed to be safe by the gold that they already have in their inventory. And the difference about this plan and what they normally followed was that they mainly focused on their shareholders, but this banking law made it for the interest of the public. Pre-World War I continued. So between 1984 and 1990, the Director General was Giuseppe Marchiori, and he cared more for the shareholders rather than the general public. And this was actually hurting the banking system. So in 1990, Italy appointed Bonaldo Stringer as their new general director. And in 1907, this began a more thorough supervising team for the Bank of Italy. So they wanted to prevent biases in the banking system. They wanted to prevent criminal activities such as money laundering. And the history in World War I and World War II. So in World War I, these banks served to help with direct credit, meaning they were able to issue war loans and manage financial options. And they had ties between the lira and gold, but that actually ended during this war, causing small banks to suffer. And they started bailing these banks out with salvage operations, which in the end of things actually gave the Bank of Italy full control of these credit differences. And at the end of World War I, it began as the true central bank and overseer of the credit system. And in World War II, the country was divided because of the war causing harm to the economy. So they had to pay for way too much damages and things. And the lira was worth one-fifth of its initial value during this war. And to help with this problem, they developed a four-step plan through the years of 1945 and 1948. And step one was to stop inflation. And step two also was to set a new limit to amount of money available to finance in the country. So they wanted to put a limit on how much people could use debt. And step three is when they join the international finance community so they can ask other countries for help rather than just relying on their main currency. And step four was the reorganization of banking supervision. Again, they stress the importance of the corruptness in the banking system for Italy, and they just wanted to prevent that again. So after World War II was the conclusion of the Bretton Woods system, and they switched to floating exchange rates. And when sharp oil prices rose, it actually hurt the bank. So these floating exchange rates and the sharp oil price rise was detrimental to the Bank of Italy. And this resulted in them facing inflation and stagnation. And in 1978, Italy joined the European monetary system. So the structure of the Bank of Italy. It operates at three different levels: the international level, the national level, and the local level. The national level has 10 different sectors, and the local level is where majority of the supervision occurs. So overall, they have 39 branches and 20 are located in the regional capitals. 6 branches are in charge of handling cash from issuing and distributing banknotes. And the Bank of Italy is currently being reconstructed, which will close down 22 branches again to gain more control so that there's not any biases or criminal activity in the Italy banking system. So some unique factors of the bank are it is an integral part of the Euro system, the competent national authority for the SSM, and it shares tasks with the European Central Bank. And similarly to the way that American companies disclose their information is the same way this bank has to. So they have to disclose information to their government, to the parliament, and even to the public so that the common person knows what this bank is doing and they know that they can trust them as their main bank. And 6,800 people work for this Bank of Italy, and they all have a variety of skills so that they can prevent biases again. And I'd like to invite Pat to talk about the 2008 financial crisis.
Okay, for starters, Italy was one of the European countries hurt worst by the 2008 financial crisis. Economists reason that the transition to the euro 7 years earlier was a big contributor. When the financial crisis hit, United Kingdom's Prime Minister, Gordon Brown, released a plan to increase liquidity support, interbank lending guarantees, and recapitalization of failing banks. The European Central Bank and President Jean-Claude Trichet agreed to follow suit. Brown packaged £500 billion to aid Europe for the agreement. Refinancing operations were already a tool used before 2008, where the ECB may package cash to needing banks for low interest rates around 1%. Collateral must be provided, which was usually sovereign debt. Before 2008, these refinancing operations matured no longer than 3 months. The crisis made the ECB create long-term refinancing operations. These were similar in concept to the original operations, but had a maturity of 1 year. 3-year very long refinancing operations, or VLTROs, were soon to follow. Italy was one of the 5 European countries to receive such operations. In 2010, when these VLTROs were close to maturity, some countries were not restabilizing as anticipated, especially in Italy, Spain, and Greece. The ECB created the Securities Monetary Program, where the ECB targeted buying public and private bonds from struggling countries, increasing liquidity to these countries at the cost of increasing the ECB's balance sheet. The outright monetary policy was put in place soon after, had the same utility as the S&P, but uncapped the 220 billion euro limit on purchases. Italy's own policies included allowing 40 billion euros worth of treasury bills available to be purchased from banks to ease the workload of the ECB's monetary policies. As well as they made the minimum banking savings level increase from 20,000 to 50,000 euros to ensure stabilization. And now we will move on to comparing the Bank of Italy to the Federal Reserve. The first and most obvious difference between Italy's central bank and the Federal Reserve is the different currencies. The Fed uses their very own currency of the dollar, while Italy uses Europe's euro. While Italy is overseen by the European Central Bank, the Fed is not subordinate of any other bank and are in complete control of their own currency. Citizens of Italy who wish to be aware of financial matters must be aware to check both banks' financial reports and monetary policy changes to remain up to date. The governing board of Italy consists of the governor, senior deputy governor, with 3 other deputy governors. The U.S. Board of Governors consists of 3 more positions with a chairman, vice chairman of supervision, and plus 4 other governing positions with 2 that remain vacant. Both banks elect positions in opposite of government official voting, and a position on Italy's board lasts 7 years with a chance to be re-elected once, while U.S. terms go for 14 years. Italy has 39 branches with 20 in the capital. The U.S. has 12 districts with a location set based on financial needs. For example, New York has high liquidity needs, so this state has a district of their own, while some districts will cover multiple states. This may be because of the sheer size of US compared to Italy. The district use is not necessary in a smaller country focused on local modernization. And just to conclude, the 127-year-old Central Bank of Italy has had a very difficult path of changes, corruption, and recessions to deal with. The control of the local, national, and as of 20 years ago, and the change of the euro, international level of their financial system. With monetary policy still being used to help with the 2000 financial aid crisis to this day, such as the outright monetary transaction policy, and the corona pandemic inflicting so much damage on their people and economy, the bank will have their hands full for the upcoming future. That is all, and thank you for listening. Have a good day.